So chasing returns is really one of the biggest mistakes that an investor can make. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer, and excited to have you here. Say, if you've been a listener this is your first time listening, doesn't matter. Welcome to the show. If you've been a listener for a long time, I really appreciate you listening and continuing to be a supporter of the podcast. I would love for anybody listening to share this out and give a rating and review if you haven't done that yet. Let's talk about what's on my mind today. And what's on my mind today is chasing that shiny object. And when I'm talking about chasing the shiny object, I'm talking about chasing the shiny object as far as investment returns. And it's really easy to get excited about investment returns. I've gotten excited about some investment returns on deals that I've done. I would tell you what, most of the deals that I've done that I have not done well on, it's where I'm chasing the returns. And I get excited about what it looks like on paper. And whether that's a deal that I purchased myself, a real estate deal that I purchased myself, or if it's something I invested in. I've invested in some tech companies and different things like that. And always, it seems like my worst investments are the one that look the best. They always look the best on paper, right? They look so good. And so when I consider my portfolio, and then I do the research on everybody else's portfolio, Warren Buffett and everybody else that does really well in investing long-term, not just today, not just over the next, year or two, but long-term. I'm talking your entire life. What is the same for everybody is they're not chasing the shiny object. They're not chasing returns. So chasing returns is really one of the biggest mistakes that an investor can make. When we're talking LPs in real estate investing or the GP in real estate investing, again, chasing returns is the biggest mistake. I give you a perfect example. So when I'm looking at, I did really well in the Twin Cities investing and made a good amount of money in the Twin Cities. Flipping houses, buying 1 to 4 family homes, all that kind of stuff. And then I decided, look, I'm going to branch out. I'm going to start going to some different states. And one of the things I did, the first state that I went to was Wisconsin, our neighboring state. I went to Milwaukee, Wisconsin, and I decided I'm going to buy these properties in Milwaukee because, man, the prices are cheap and the returns look fantastic. They look amazing. I can get such good returns. In fact, why would I ever consider investing in the Twin Cities again when I can get returns like this in Milwaukee and it's only 5 hours away? So I started investing in Milwaukee. I bought several duplexes. I bought some houses to flip. And man, the struggles happened. The returns on the piece of paper weren't actually happening in real life. Now, I did okay. I flipped a house. I did fine. I made some money, but it wasn't nearly what I would have expected to do. Instead of making 40 grand that I projected, I ended up making like $14,000. Okay, still made money, but again, chasing that shiny object, it didn't work out too well. And would I have done that deal if I would have known I was only going to make $14,000? No, I wouldn't have done that deal. And then these rental properties, so the returns look so good. I was going to be able to cash flow, $700-800 a month. It was going to be fantastic. Appreciation, the market was going to grow and it was going to be great. Instead, what I ended up doing is buying these properties that looked fantastic on paper, but ended up just being they all made money. Yes, they all made money, but they just were not great. And I'm sitting here driving to Milwaukee, or, it's like I can either take the bus, I can drive, or I can take a plane. We'll take, driving bus or plane was all just too expensive, right? So it just didn't make sense to go there because if I go there, I'm eating up all my cash flow and I'm not making much money. So I ended up selling completely out of Milwaukee. learned my lesson there. Like, hey, look, stop chasing that shiny object. The the returns on paper can look so attractive. And I've heard it so many times from people, like, it just, man, these returns are so good. And it's like, no, you're missing X, Y, and Z. You're not thinking about this. You're not thinking about that. So you've got to think about what actually is going on with these properties before you jump in, and what the real expenses are and what your real risks are before you jump in and buy something, or as an LP, right? And really that goes with any investment. Let's talk specifically about a syndication. And when we're looking at investing in a syndication, well, and we can even, like, this relates to really anything, quite frankly. It doesn't have to be a syndication, but look, understand, first of all, past returns don't predict future performance. So if you see a syndicator that is touting their great returns, especially if they're like, oh, look at these returns. I went full cycle on these deals, and you look at the deals and they're from 2021, 2022. Of course they did amazing. That's when the market was absolutely on fire. You could literally buy a property, fall asleep for a year and a half, wake it back up and sell it and make a pile of money. So the returns, of course, were good. So, any sponsor that had a deal that they purchased it, 2018 through 2020, and they sold, it doesn't matter when they purchased, I guess, if they sold it in 2021 or 2022, they should be able to show you good returns. Like, no brainer, right? So those, although they're important, and I don't want to say, well, don't look at past deals, just understand, like, that's truly what we're just looking at, a little snapshot. Like, those truly should be great deals. So you want to look at deals understanding the market cycle, the interest rate fluctuation, how asset prices have adjusted. And you want to look at deals today that actually fundamentally make sense for today. You also want to look at the sponsor's track record and what they bought from, 2018 through 2022, 2023, and actually how they're performing today. Are those properties truly performing? And you want to look at that and see how they're doing. Does that make sense to continue to invest with that sponsor? And, they might have a bad deal or two. Okay, cool. Explain that to me. Like, what happened? How did that happen? How are you mitigating that in the future? Like, hey, oh yeah, we've got a bad deal. We bought this deal. We put bridge debt on it. Okay. I've got a couple deals that we put bridge debt on. Those are not, bridge debt is not performing well right now for anybody that has bridge debt. They're not performing the way they should be. Some are doing better than others, but they're just none of them are performing extremely well if you put bridge debt on in 2020, 2021, 2022, right? So how did you change? What did you do? What are you doing differently? If they're like, well, I'm just doing the same, I'm doing it the same because we did really well before. Okay, wait a second. You're telling me you've got some properties that aren't working so well, but you're doing the exact same thing. You got the exact same strategy going to, meaning you haven't learned any lessons. You haven't really thought about what went wrong and why that went wrong and how do I fix it for the future? No, you're just doing the same thing. So what are you doing to fix those mistakes that you maybe made? I think that's really valuable to be looking at those sponsors and saying, what mistakes have you made and how are you not repeating those? For us, we are fixed rate debt investors, and we've always really been that, but not 100%. And right now it's like, hey, 100%, we're doing fixed rate debt because we see that all these companies that have been around for decades and decades and decades, not just the last 5 years, not just the last 10 years, the companies that have been around for the test of time, they stick with fixed rate debt. Every one of them. I haven't met one company that's been around for a long period of time that does floating rate bridge debt. It just doesn't, I don't think they exist. I think those are the companies that are on short term. And so we looked at that and said, do we want to be a company that's around short term or long term? Long term is the answer. And so we have changed our approach. And not that we were all bridge debt before, but that this is where we're at. So again, future returns, you can't look at necessarily past performance. Again, it's important, but make sure that you are not just chasing that shiny object. Understand too that high returns can oftentimes come with high risk, and they should, by the way. So if a deal is being promoted and it's got high returns, it's going to likely come with a higher degree of risk. And so is it a massive value add? Is it bridge debt? Is it very speculative, right? What are we looking at? And so you want to look at those deals, and quite frankly, every deal, whether it's promising really high returns or not, you want to look at those deals and go, okay, what kind of leverage do we have? Not what kind of leverage do we have on the future value of the deal, but what kind of leverage do we have on the current value of the deal, the renovation amount, all that kind of stuff added together. What's the actual leverage? Where are we at with the debt service coverage ratio? Can we pay our bills? Can we truly pay our bills on day one? What is that DSCR? What are the fundamentals happening in the market? And get granular. Get like what's actually happening truly right there, right? Understand the underwriting and how they're looking at things. So chasing returns, chasing high returns, again, often come with high risk. Now, nothing wrong with it necessarily if you've got some money to play with, but just be cautious and understand how those risks are being mitigated. For instance, when we've got a deal right now, okay, we think it's going to make great returns for investors, but it does come with a little bit higher risk because it is a big value add project. So how are we mitigating those risks? And I think this is really important. So when we look at this deal that we've got, how are we mitigating risk? It's a 100-unit building, 99-unit building. We're putting $4.1 million into it. It is 65% occupied. And we have, if I just tell you that, you're like, whoa, no, that doesn't sound like a good deal. Okay. Well, here's the thing. Just a fantastic location right on the river, gorgeous location, high demand area. It's in a city that has got 98% occupancy. Rents are extremely low. Even if we can't get the pro forma rents that we're achieving, just the market rents for a C-class building in that area that's not on the river, we still make double-digit IRR. So we still do well. Okay. So there's a risk mitigator saying, what if you can't achieve your pro forma rents? Well, if we can't achieve our pro forma rents, what is kind of the bottom of the market? When we look at the bottom of the market, we go, okay, yeah, still works, right? The deal still works. When you were doing a big value add, the biggest risk, in my opinion, there's two big risks in value add. First of all, it's can you get the project done on time? And can you get the project done on budget? Those are two huge things. So how do we mitigate those risks? Okay, so we are prepaying our lender interest for a year and a half. Okay, so that's huge. We're prepaying the lender interest for a year and a half. We don't have to make a payment to the lender. Number two is we have a $900,000 reserve account, which is equal to about a year and 3/4 worth of interest payments. So really, when you look at that, our interest reserve plus our reserve plus our prepay of interest, we actually can pay that mortgage for almost 4 years. sorry, not almost 4 years, about three and a quarter years, 3.25, 3.5 years, somewhere right around there. I have to do the exact math, but about three and a quarter, 3.5 years. We can pay our mortgage for that during this whole period. So that's huge, right? And then when I look at our construction budget, what do we have extra? Okay, our budget's 4.1 million, but out of that 4.1 million, there's another $800,000 that is actually just reserves. So I've got 20% reserves built into this budget on what happens if things go wrong. So we got a big contingency sitting there on that. So we have a ton of cash, extra cash, that's going to insulate us and protect us from those potential risks. Now, what happens about the timeline? So the timeline, of course, things can go wrong. And part of the protection of the timeline is that we've got big reserves, right? That's of course one protection. The other protection, or the other thing that we did, is we hired a general contractor, not general contractor, a project manager that has a ton of experience with these types of projects. They remodeled a 700 unit apartment complex in 18 months. They've remodeled 150 unit apartment complexes in 12 months. Okay. We built out a budget of this 99 units, taking us 18 months and 24 months to stabilize. Actually, a little bit more than 24 months to stabilize. We think we can get it done in 12, actually 10. But we're not underwriting that. Again, we're trying to be conservative. So those are the types of things you want to look at and say, okay, well, this is a little bit higher risk deal, but what is the GP doing to mitigate those risks? And again, even if it's a low risk deal, what is the GP doing to mitigate my risks? The thing that'll happen when you chase big returns is you're typically going to be entering at the wrong time of the market. When the biggest returns seem possible is when the market has been hot for so long. And so you saw this. I actually read a story about this. This guy was he was listening to a presentation, and the presentation, one of the GPs was on, and there's sirens going on in the background, and they asked what the heck the sirens are, and the guy says that he's an EMT driver, and he's the guy that's running this deal. He's an EMT driver. Like, that's the type of stuff that's happening. They are purchasing this building. So they're purchasing the building. They're going to be the highest price per door that has ever sold in that market. Their main strategy was that the market is going up. That was their main strategy. The market's going up. Look, if somebody right now tells you what their strategy is, and they're like, well, look, building is going down and people aren't going to build as much. And so rents are going to go up and occupancies are going to go up. And so we're going to ride the market wave. Run. Okay. That's not a strategy. So make sure there's a real strategy. And again, chasing returns, you're likely going to just enter at the wrong time, because returns seem the worst when times are the worst. That's when returns are actually the best. When I first started in 2008, the money was shut off. Like, nobody was investing because returns seemed dismal, and they were dismal. If I bought something in 2008, then everybody thought you're crazy. The returns are so dismal. It's really easy to look back and go, well, Dax, man, that was a great time to buy. What are you talking about? Well, yeah, it's easy to look back and say that, but they looked dismal. You looked like that was the worst time to enter the market. And the best time to enter the market looked like at the time. Now it's easy in hindsight to say, no, come on, man, that was a terrible time to enter the market. Duh. But at the time, the best time to enter the market was 2004, 2005, right? The best time to enter the market was 2021, 2022. That's when it seemed like the best time to enter the market was. That's when the returns looked so sexy, so attractive, and everybody wanted in. Um, Here's the other thing. Like, look, make sure make sure that you understand your strategy. Here's what I feel a lot of people do is I'll talk to investors and they'll tell me their strategy and their strategy, capital preservation. I'm investing for my kids for a legacy, blah, blah, blah. And they've got these great ideas of why they're investing. I love long-term cash flow. Why do you like real estate? Well, because I love the cash flow. I love this security of it, all of this kind of stuff. And then I watch what they get into. And they get into a deal that just it doesn't fit their strategy. It's total misalignment. And I'm going, why are you investing in this deal? Well, it's because the returns look so attractive. I'm going to chase those returns because they look great. And it's like they justify it. Well, I'll just do this one, right? I'll just do this one and chase. And so they chase these returns. And that's how you get burned, right? And that's how poor decision making happens and you start to risk your capital. So look, it should be about capital preservation when you're investing, and make sure you have a real strategy and you actually truly follow that strategy. There's a reason you came up with that strategy. There's a reason you loved the type of investing that you planned on doing. Follow the strategy. Here's the last thing I'll say about big returns. Okay. Big returns are easy for anybody to offer you. It just doesn't mean it's correct. Okay. Anybody can manipulate a spreadsheet. Anybody can tweak projections a little bit. I remember looking at a sponsor based in the Carolinas. I looked at one of his deals. This is years ago. And let me start over. I did look at his deal, but prior to that, we were actually looking to enter into that market. So I underwrote that deal. And then I saw the deal and I'm like, oh my goodness, right? He is underwriting. He's saying the market cap is like a 4.25 and they're going to exit a 4.75. Well, guess what? The actual market cap was more like 5.25. So he was saying he was going to exit at 5.75. Actually, the cap rate was going to compress. His rank comps were through the roof. It was just, to me, like these projections, these optimistic projections were just crazy aggressive. Now, to his credit, the market ended up behaving really well. So I'm sure, I don't know, I didn't follow it. I don't know if he exited at the right time, but if he timed it perfect and he sold in 2022, he probably did really well, right? If he kept it though, man, I mean, he just was so aggressive. Why did he say the market was at a 4.25 cap rate? Because that's what he bought it at. He just overpaid. And he told his investors the market was 4.2. No, the market's not 4.25. You're just paying 4.25, right? That's not how we justify market value cap rate. It's just not, now we don't say the market sells for $200,000 a door when no, the market sells for $165 a door. You're just willing to pay $200 a door. Like you can't make your own market. So anyways, just be conservative out there. Think about the returns. You do have to take some leaps of faith. So I agree with that. But it doesn't mean you have to chase the shiny object, and especially the shiny object that you don't fully understand. I think that's the biggest part about it all, is that you need to completely and fully understand the investment that you're getting into, and it's got to work for you and your investment strategy and goals. No matter what you're investing in, whether it's real estate, whether it's crypto, which I don't like, but you might love. It could be stocks, it could be private companies, it could be oil and gas. It doesn't matter what it is. Just make sure you completely understand what you're investing in and it aligns with your goals. and you just have a long-term outlook of where you're at. And of course, everybody's at different points of their investing career. And so, yeah, certainly the older you get, the more long-term and conservative you want to be. When you're, 70, you probably just don't want to lose a ton of money unless you're sitting on piles and piles of cash. All right. Well, that's all I got for today. You have a fantastic rest of the day. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.